Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets themselves, focus on the charts and what they can tell us about market conditions. We've talked about the distribution phase, this transition from accumulation phase to distribution phase. We've talked about the S&P breaking its 50-day moving average, breaking key support levels, the breadth conditions that have been deteriorating, but much like the weather here in the Pacific Northwest, which is just starting to transition into the very rainy half of the year. It feels like the market is taking a cue from the local weather and certainly feeling some weakness. Going into the close today, you sort of had a downside move accelerating with the last 30 minutes finishing with the S&P at the lows. Communication services actually the number one sector today, and it's interesting in an environment like this to see where the leadership and laggardship comes out, right? And this sort of choppy move, my friend Katie Stockton had mentioned earlier today about, the lagging stocks tend to bounce and work. The things that had been leading tend to come off, and that's certainly a lot of the trends that we've been seeing. Both of the consumer sectors at the bottom of the list today, which is an interesting theme that we'll try to unpack as much as we can given our time together. We have fantastic guests on the show. I'm really excited to bring Jeff Weiss on the show here in a few moments. Coming up next week on Tuesday, we have Craig Johnson, the technical analyst at Piper Sandler in Minneapolis. Next Thursday and Friday, I will be on vacation with my family, enjoying the woods of Oregon. This show will be kept in good hands, though. My friend Julius DeKempener, founder of RRG Research, will be hosting the show on Thursday the 7th. Tom Boley of Earnings Beats and host of many shows on Stock Charts TV will be hosting this show on Friday the 8th. So it should be a great opportunity to get some different perspectives given the uncertainty we've had. Then coming up the week after on Tuesday the 12th, we have Ari Wald from Oppenheimer. Let's continue on with the market recap. So looking at the 2-day chart, you can see the difference from the last trading session, yesterday's trading with today's, right? So we've had this sort of push and pull between sort of choppy sideways days, which arguably yesterday was, right? We sort of chopped around a bit, but at the end of the day, we really didn't go anywhere. Today, we certainly went somewhere, right? We accelerated to the downside, and it was led by the mid and small cap stuff, which is a little different. What we've seen so far in this pullback is you've seen the Nasdaq sort of pushing the growth stuff, leading the way lower, and then you have things like the small caps and value oriented parts of the market holding up. Here is a little different, right? You had the Nasdaq actually holding up okay, and earlier in the day, the Nasdaq was actually positive while the Dow was down, and then the S&P was in the middle, and that's sort of a familiar pattern that we've seen going around. Here, the S&P really pushed to the downside. The Nasdaq was only down about 0.4%. The Dow Industrial is down 1.6%, and the VIX is back well above 20, around 2350. Other asset classes very quickly. Interest rates chopped around for quite a bit, and the 10-year yield actually went above 155 earlier today, settled in to close the day around 153. Now, again, that's fairly elevated from where we were a couple months ago, but not still well below where we were earlier in this year when we were up in the 160s, 170s. So if you're wondering how high rates can go, the answer is a lot higher. And the other answer is they can go a lot lower. And we've seen just in the last couple of years, there's quite a range that those things can do. So don't, remember that just because rates have come up a lot recently does not mean that they can't continue to accelerate higher. And so it's something to pay attention to, particularly when the 10 years back above 1.5%. The dollar index we talked about yesterday because really spiked higher. Today settling down a little bit, but coming out of that, what you call a cup and handle pattern, sort of a big rounded bottom and then a shallower pullback, and then breaking out in the last couple days. Commodities, you actually had gold going higher. So if you've been waiting for this moment where gold feels like a safe haven, stocks are down, gold is up, you finally got it. Today was the day with gold bouncing higher, the GLD up about 1.8%, silver up 2.9%. We're going to look at that chart here in a moment and think about it. Overall, oil prices were sort of flat to positive, although the energy sector got beaten down along with everything else. Cryptocurrency is also in a bit of a recovery mode here. So it's interesting actually to see the contrary relationship or the inverse relationship to the dollar index and to cryptocurrencies. Yesterday, you kind of had the opposite with the dollar working and cryptocurrencies remaining relatively weak. Today, you actually, or in the last 24 hours, really, you see Bitcoin bouncing higher over 5%. The same with Ether and other asset classes as well, with Ethereum right at the 3,000 level. It might be an interesting big round number level to pay attention to. Let's look at the chart of the S&P 500. We'll try to touch on a breadth chart or two, and also look at gold as well. So the S&P coming off again today. We're testing the intraday lows that we set about a week and a half ago, 2 weeks ago. This was the big drop. I think that was that Monday where we dropped down and gap down from the test of the 50-day moving average. This is the day when we actually broke below the August low, undercutting the previous month's low, which was significant. From there, we bounced up to the 50 down, and now we've continued to roll over. So we're currently around 5.5% below those all-time highs from early September, around 45.50. I put, if you can see in the background, I didn't want to make them too bright and bold and red, just in case we risk getting too negative here. But what are some potential downside movements? So if you think about the Nasdaq 100 and the sort of short-term head and shoulders pattern, which is basically a high surrounded by two lower highs, you see a very similar pattern on the S&P now. If you take the height of that pattern and project it lower, you get around to this range, sort of the 40.50, 41.50 range, depending on how you'd measure it and what you consider the neckline and all of those things. That'd be about another 5% move below what we've had. So almost about double the pullback that we've had so far. That would accomplish some very interesting things. Number one, that would take the S&P down or a little past its 200-day moving average, which it's not touched since last fall, a year ago. It also would take the S&P down potentially to the May lows, which is right at the 38.2% retracement. So if you start the clock at the low of this consolidation pattern last September, you take the high from early September of this year, you retrace 38.2% of the way. That's around 40.35. So another 5% would actually take us to a significant cluster of support levels that I think could be very, very interesting. The question is obviously how we get from here to there. And I think that's where the short-term analysis really makes some sense. Clearly, we're in a bit of distribution mode. The breadth conditions, a lot of the seasonal tendencies have been suggesting negativity for quite a while. I would argue now we're starting to see price follow through to the downside. And the question, I think, overall is how much of this is a short term reset versus a long term distribution. And I think that's one of the things, hopefully, with my guest, Jeff Weiss, we'll talk about here in a few moments. Very quickly on breadth, and then we'll get to some of the chart of gold as well. So when we think about breadth conditions, there are two charts that come to mind. The one is this one, which is the cumulative advanced decline lines on a couple different parts of the market. So we have the NYSE line at the top that's using only common stocks. Then we have the large cap breadth line, the mid cap breadth line, and then finally the small cap breadth line. All four of these, I would argue, have now rolled over, right? All four of them below their 50-day moving average. A number of them had this bearish divergence in June and July. And I think that was potentially an early warning sign, at the very least, indicating the stealth correction we've been in, where a lot of smaller mid cap names have actually been, pulling back quite a bit, and already have retraced much more than 5%, 10, even 20+% in certain parts of the market. So we saw some of this breadth deterioration. Now the question is, do these advanced decline lines continue to trend lower? And that's where I think remaining below their 50-day moving averages, making a new swing low, undercutting their low from September, all would sort of further validate this idea that the market may have further to go on the downside. By the way, I recorded a video for my own YouTube channel called Market Misbehavior earlier this week, focusing on breadth conditions right now versus 2020, 2007, and 2000. So check that out on YouTube if you didn't see it already. The other one I would point out is this one. This is looking at the percent of stocks above their 200-day moving average, currently 70.5%. And that's not updated through today's close just yet. That number most likely comes down a little bit. But this was at 95% plus there in April. So it's come down quite a bit. The percent of stocks above their 50-day was at 92% in April. It's now down to 35, 34%. So you've certainly seen this deterioration. And again, what this tells you right now is 2 out of 3 stocks on the S&P are already below their 50-day moving average. Most of them still above their 200-day, but that is certainly something to pay attention to. That indicator remaining above 50%, by the way, has differentiated over history a lot of the shorter term pullbacks, even the September, October correction from last year versus a deeper pullback in terms of price. We'll finish off with gold here just with a moment or two, but the GLD is a chart we've looked at quite a while, and I just want to put today's move in context. So today's certainly a bounce higher. That's encouraging. Coming off of a relatively low level, that's encouraging as well. Potentially testing that same low just above 160, 162 from August. So we're bouncing off that same level today. But let's keep in mind that the longer term trend, I would argue, still is negative. What would tell me that the trend is no longer negative, putting in a higher low, would certainly be encouraging. The RSI getting above 60, which would tell you you're rotating more into a bullish phase, would be encouraging. getting the price to make a new swing high would certainly be the ultimate indication, which we failed to do on the last couple attempts. We need to take a quick commercial break. We'll be back with my guest, Jeff Weiss. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we focus on the markets using the power of technical analysis, using data visualization techniques to understand investor sentiment, investor psychology. Couple quick comments before we get to today's guest, Jeff Weiss. First off, we love to hear your questions on anything, on technical analysis, on particular charts that you're struggling to understand, on how the world has evolved from a technical perspective, on market history, market dynamics, whatever it is. We'd love to point you in the right direction. Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We would love to hear from you. Hope to answer one of your questions in our next mailbag segment on Friday's show. Also, do me a favor, go to stockchartstv.com. That is our on-demand platform. You can access it from the website, also from your mobile devices. Great special events like the pitch from earlier this week, our year-end special, our market outlook coming in January, and so much more on our website, stockchartstv.com, or on your mobile device. Just go to any of the app stores and search for Stock Charts TV on demand. I want to welcome on today's guest, Jeff Weiss. Jeff, I'm super excited to have on the show because he was one of my early mentors in the industry, taught me a lot about analyzing the markets. And I distinctly remember, Jeff, sitting down with you with paper charts, drawing long-term trend lines and focusing on the patience of waiting for weekly and monthly closes to make sense of things. So we need your long-term perspective, and welcome to the show today, Jeff.
Dave, thank you very much. Been many decades, and I appreciate you having me on. You're far too kind with a mentor comment.
No, it's awesome to have you, and I'm excited for the viewers to get a taste of how you're looking at things. We're starting in Europe. This is the Stocks Europe 600 index that you've shared with us, a weekly closing chart. Talk us through what you're seeing here.
Okay, Dave. I thought we'd start with something in Europe before heading back to here to our own shores. I wanted to just circle the week ending July 17th, 2015 peak, and then the big peak, that second red circle back in the week ending February 14th. Some Valentine's Day top, huh? And that was week ending Friday or Thursday of Friday's close. And you could see the plunge followed by the rally just above the line. And then looks to me like a single week pullback that held the line, followed by an extension of that already significant rally. That line is one I'm watching for Europe. That line this week is roughly in the 439 it's 439.35, rising 10 to 11 cents per weekly close. And again, to me, my friends, technical analysis is really an art, more of an art than a science. So I'm giving you exact numbers, but there's a little bit of play in that number. So right here, this the uptrend has not yet been broken according to this trend line, which I think offers potential intermediate term support, slightly below current levels.
Now, your second chart, getting back to the U.S. here, the S&P 500 going back to 2018. Are you seeing a similar picture here in the U.S.?
Well, in a way, I am, Dave. Some of these, some of the charts I did not feature. The prices are so far above their trend lines that you can have a reasonably sized reaction without violating lines. But nearby potential support, according to this chart, which shows you four intra-week highs along and around the blue trend line, followed by a move above the line, and then two successful intra-week tests of the line, which I believe occurred this past May, followed by new highs, makes this line, which dates back to, I'm just peeking here, the week of October 8th to 12th in 2018, one to watch intermediate term. The line is at 4225.06 this week, 4233.64 a week from tomorrow, and then 4242.22 2 weeks from tomorrow. The line is rising roughly 8.58 points per week. And I think that is a line of potential import because of how long it's been in evidence and because of the price swings we've seen when the line has been approached on the upside and when it was tested, as we saw this past May, on the downside, my friend.
So your third chart then, Jeff, is talking a little bit more about the short-term dynamics here, looking at the last couple of years. And we've certainly seen the pain this week of stocks starting to come back. Talk us through your perspective here. Where are we at in this rotation?
Well, Dave, in a nutshell, this line goes back to really the end of 2018. And then I noticed some shaded regions which connect peaks along and around the line. After pulling back from that second shaded green region, we pushed right through it. And the fact that we held on the retest at the red circled low and then ran to multiple new highs makes this line, to me, one of potential nearby import for the S&P 500. I notice here that it's at the end of today, I believe, 4264.48, and it is climbing 2.07 to 2.08 points per session. In a nutshell, the bears need to conquer these lines on those three charts. And then I think they have the opportunity to build some momentum on a near to intermediate term basis, even if they do not succeed in penetrating the longer term uptrend lines, which go back quite a ways on some of the popular averages, Dave.
Jeff, it is so easy to get caught up in the short term, what I call the flickering ticks of the market. And as always, you're reminding us to pay attention to the long term trends and focus on how those were evolving. And thanks for giving us some specific levels to pay attention to. Jeff Weiss, thank you so much for coming on. Thanks as always for being a mentor and a friend, and stay safe. All right.
And to you and to your audience, Dave, I can't thank you enough for all your support over the years. God bless.
That's Jeff Weiss. Jeff is a technical analyst at Clearview Trading Advisors in New York, and was at a firm, Jessup and Lamont, one of the oldest brokerages in New York, for a number of years. That's where I first met him. And if you hear how he describes some of those long-term charts, what I love about Jeff and his work is I would get so caught up. At the time I first met him, I was working with a lot of hedge funds, looking at a lot of really short-term price dynamics. And I'd go in there thinking to talk with Jeff about all these short-term fluctuations. He would have these really long-term trend lines and focus on how these markets were evolving over time. And I think it's such a great perspective to keep in mind in an environment like this, where it's so easy to get caught up in the short-term movements, the short-term trajectories. Remember to make long-term decisions using long-term data and long-term charts. Great take from Jeff Weiss there. Our next segment is called Getting Sentimental. What we love to do on Wednesday into Thursday is review some of the sentiment readings. A lot of them are, weekly data that are updated, Wednesday afternoon to Thursday morning, Thursday afternoon. So it's a good time to sort of see where we're at relative to some of these trends. The more that the market pulls back, the more we're looking at this chart of the VIX. And I come to mind a couple of weeks ago, we were looking at this chart and talking about how the VIX, every time we'd seen a pullback about the third week of the month, right around options expiration, the VIX would spike, the S&P pulled back. There's our repetitive pattern. And I remember talking about that pattern is going to work until it doesn't. And now we are seeing a month where it doesn't work, right? That sort of expectation made a ton of sense, and it certainly had worked fairly consistently. I hate to use the worst four words ever. This time is different, but certainly relative to the last couple months, we're seeing some different dynamics now than we have in the previous months, right? Where it was a very 4 week, pretty straightforward cycle, spike in volatility. This is showing you elevated volatility. You can the connotation is elevated fear, and overall, the markets do not appreciate uncertainty. They like stability and more certainty. So certainly feels like unstable period at the very least in the short term here, according to the volatility picture. The sentiment picture has changed a little bit when we look at survey data, depending on which survey you're looking at. So, looking at the AAII survey, this is the American Association of Individual Investors. There's a series of individual investors that are surveyed once a week and asked if they're bullish, bearish, or neutral. What we've seen over the last week is not a ton of a change, but what we've seen over the last couple months is a significant change. So back here in April, we talked about those breadth readings being very elevated, right? 95% of S&P stocks above their 200-day, 92% above their 50-day. You had almost 60% of the respondents saying that they were bullish on the stock market. Look at where we're at, even recently, right? As the market's making new highs going into early September, that number is just about 42%. So, it's about 10% lower. And every time the market made a new high, you sort of had lower and lower bullish sentiment. Now we're actually below 30%, which is really at the lower end of the range. Certainly one of the lowest readings we've had year to date, with the exception of 2 weeks ago. But overall, if you look, this is more during choppier periods like 2018. This is more of a reading that you'd have seen around that period. Also, honestly, the first half of 2020, when you were digesting the huge sell-off there, and it was sort of a lot of uncertainty about the sustainability of the up move. Where you get a much more significant change is with the name exposure index. Now, this one's a little different because these are as the National Association of Active Investment Managers. These are more money managers that are talking about their exposure to equities, and whereas the other one is talking about what your expectations are for stocks. It's actually asks you how you're positioned. Are you 200% or 100% long equities? 0% equities, 100% short, 200% short is the range of responses, and you aggregate that into a net number. And this week, the rating is 55%. That's down about 20% from where it was last week. And that's down quite a bit, about 40+% from where it was at the beginning of August. So in early August, when the S&P is making new all-time highs, you had 95% exposure to equities. Now it's more about 55%. So quite a swing in terms of money managers getting way more defensive very quickly. This is actually the lowest reading that we've had on the name exposure index since May of this year, which was, again, it looks like just a rounding error pullback here, but at the time certainly felt like it could be materializing into something more significant, similar to to March of this year. And then before that, September of the previous year, which was the beginning of a choppy sideways period. On social media, I posted I post a number of things every day on my Twitter account, and someone had responded to one of the charts talking about how sideways is a valid direction, and it's certainly something to remember. We love to oversimplify. Are you bullish or bearish on X and Y? And we love to think of things in a very simplistic binary outcome, right? Is it going up or down? But you have to remember that the market could go in three directions. The third one is sideways, and it can be super frustrating, super annoying because it feels like you don't really get anywhere directionally. I will tell you, though, that even in that environment, there are going to be stocks that are working and stocks that are not working. And that's what I would certainly point you to as much as possible. Finally, I'll point you to the put call ratios. When we look at the total put call ratio and the equity put call ratio, you can see that they're fairly elevated. The total one, which includes index options, is actually at the upper end of the range, similar to where we were in mid-August, which was the pullback here, and similar to where we were in May of last year. May of this year, excuse me, where the put call ratio got to these elevated levels. So overall, we're actually nearing some of the points where we had bottomed out previously. What you have to remember is in periods of steeper pullbacks, of steeper dislocations, you'll see the put call ratio spike a little further than where we're at right now. So it's by no means bounded on the upper end by some sort of particular value. It can spike a lot further than it is. The equity only put call ratio is actually more mid-range relative to where it's been. And I would argue no real clear signal relative to where we've been. It's about the middle of the range that we've been for the last year, 12, 13 months or so. That is our sentiment reading. And again, what's interesting to me is the spike of the VIX and particularly the name exposure index, which has come down significantly, which shows you money managers are certainly starting to get defensive. We need to wrap the show and go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the new Dow theory. We talk about Dow theory, which is the Dow Industrials and the Dow Transports. The essence of what Charles Dow was trying to accomplish over 100 years ago was understanding the different pillars of the economy and whether they were agreeing or not agreeing. Now, I would argue a new Dow theory should use the S&P 500, representing the old economy, very loosely speaking, and the NASDAQ composite, which represents more of the new economy. What we're seeing today, given the pullback that we're seeing, and with the NASDAQ coming off as well, as I think we're confirming a bit of a breakdown here with both the S&P and the NASDAQ composite on a closing basis getting below their August lows. That's the first time that's actually happened in quite some time. We've had both of them confirming a breakdown of the previous month's low. Second chart would be the Communication Services ETF, the XLC. One of my guests weeks ago talked about the XLC, Communication Services, being the market. And if you don't want to look at the S&P, just look at the Communication Services ETF. The XLC will tell you what you need to know. And while the S&P has been chopping around and certainly starting to show weakness, look at how the XLC had been consistently above its 50-day moving average, and very similar to what you saw with the S&P. It's even tested the 50-day even more classically and is not really broken down at all until this week, right? A couple of weeks ago, you get the gap below, the retest, just like the S&P, and now rotating lower. So when we talk about some of the weakness in some of these growthy sectors, this chart is what jumps off the page of me. And it's also names like Microsoft and Apple and Facebook and others that had been just consistent uptrends that really rolled over and started to break down in a way that we've not seen in quite some time. Finally, FactSet Research Systems, which is FDS, which is in the communication services sector. This is really a market data firm. And overall, what I wanted to point this out is even in a sector, in a market that is struggling, even in a sector that is pulling back and struggling on a relative basis, you still have stocks that are breaking out. You will always have stocks that are breaking down. It's a great reminder that pretty much in any sector at any time, you can find things that are working and find things that aren't if you know how to screen for those ideas. I ran a screen earlier today for my market misbehavior clients, and this is one of the names that we talked about, FDS. So in a sector that's struggling a bit, you have a broad basing pattern over a year old. You see the breakout, the test of that support level in August, now breaking down and testing the 50-day and rotating higher. So it's actually making new all-time highs while the market is struggling. I would never mind aiming for stocks like that in a time when the market overall is struggling. If there's anything to be concerned about, I would say the bearish divergence August into early September, and I would keep an eye on that and see if there are any potential weaknesses there. Folks, that is our show for today, and I want to take a moment. This is actually the 2-year anniversary of when we originally launched the Final Bar. I want to thank you all so much for watching the show. It has been so much fun doing this. We are not stopping anytime soon. We have a blast putting the show together, and it's a pleasure to bring on some of the great guests that we've had. I just wanted to mention a couple of people that are super an important part of the show that are not in front of the camera very often, but do more work than I do. Gretchen Pitluck is our producer. Our Zach Dillon is our technical director. Rachel Ackley signs up all of those great guests that you see. We also have a graphic design team, editors, and many others that do a lot of work behind the scenes to make the show look and sound very, very good. I just want to say thank you to you for watching the show, and a special thank you to our team here at StockCharts.com for doing a fantastic, fantastic job. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.